Okay, let's take a look at a couple of others of these assignments that are part of Chapter 5, Part 2. So first we need to make an adjusting entry for depreciation. And they tell us that on December 1st, delivery equipment was purchased for $7,200. It has a useful life of 4 years and no salvage value. And we want to use our straight line depreciation formula, analyze it using T accounts, and then enter the adjusting entry. So let's go ahead and do that. December 1st, delivery equipment was purchased for $7,200. So on the 1st, we purchased this equipment for $7,200. So we would have debited equipment and we would have credited, if we paid cash, we would have credited cash. If we had purchased the equipment on account, we would have credited accounts payable instead. Okay, so that happened on the 1st. So now what we're looking at is the end of the period, the end of the month. And we want to say how much did we use this equipment for 1 month. And so we're going to use our straight line depreciation formula. So our first step is to figure out the depreciable cost, which is the cost minus the salvage value. Okay? So we'll have our cost, which was $7,200, minus our salvage value, okay? And so that is $7,200 for our depreciable cost. The second step is to take the depreciable cost, $7,200, and divide it by the useful life. Now, if I put the useful life in terms of years, 4 years, then my answer will come out with depreciation for 1 year. But I only wanted depreciation for 1 month, so I'm going to put in how many months, which is 48 months. Okay? And so when I take $7,200 divided by 48 months, I get $150 per month. Okay? And so that's how much I am roughly using this asset. Now, in our insurance, our prepaid insurance and our supplies, these are assets. When we use them, we took the amount, we credited the amount out of the asset. And since we used it, we put it into expense accounts. Now here, I can't do the $150 out of the asset because of historical cost principle. So instead, I'm going to have another account that's called accumulated depreciation dash delivery equipment. And I'm going to put the $150 that I'm taking out of the asset. Instead, I'm going to take it out by using this contra asset. Okay. Where is it going to go into? Depreciation, expense. This is how much we used of the equipment. We're going to debit depreciation expense and credit accumulated depreciation. So we go to our journal entries, 31st. Okay, we said we're going to debit depreciation expense. The 150 and credit, which is indented, accumulated depreciation dash auxiliary equipment for the 150. And we're showing that we used equipment for December. Okay, and number 5 is where we calculate the book value. So on June the 1st, a depreciable asset was acquired for $68.40. The asset has an estimated useful life of 6 years, no salvage value, and we want the book value as of December 31st. Okay, so let's get this started. June the 1st, fixed asset was acquired for $68.40. Okay, and we'll use these along the side here. So, equipment was purchased on June the 1st for $68.40. So on June the 1st, we would have debited equipment and credited cash if we paid cash for it, or we would have credited accounts payable if we owed out to a vendor. That was on June the 1st. Now we have to figure out how much depreciation for each month. Now it has no salvage value, it has a useful life of 6 years. 6 times 12 months a year is 72 months. So our depreciable cost is $68.40 minus the salvage value of 0. So that equals $68.40. And we take our $68.40 depreciable cost divided by the 72 months. And that gives us $95 per month that we're going to do $95 per month that we're saying that we're using this equipment. However, we're not going to put the $95 for each month as a credit in equipment because the historical cost principle says I can't do that. I need to leave this original cost in there. So instead, I have a contra asset called accumulated depreciation dash equipment, and the $95 for June is going in there, and then we get to July, the end of July, and again we have another $95. And the end of August, we have another $95. And the end of September, the end of October, the end of November, and the end of December. Okay, so 1, 2, 3, 4, 5, 6, 7. 7 months went by since we originally bought this equipment, and every month we're crediting accumulated depreciation of the equipment. Okay, and so now we need to calculate out the book, and of course, every month we would have put that $95 in depreciation expense as well. But our formula for book value is to take the original cost to $68.40 and subtract out the total accumulated depreciation. Well, the total accumulated depreciation by the end of December is $665. And so if I take $68.40, the original cost, and I subtract the $665, I get 6175. And that equals our book value. Now, I'm not doing journal entry here, I was just calculating out the book value. Okay, for the rest of these, you just had to analyze what was happening. So I'm not going to use the Excel sheets or whatever. The ending inventory of supplies is 260. That means your ending balance of this supplies asset needs to be 260. So our what we must have used is 580 minus the 260, which means that our journal entry would be crediting 320 in the supplies and debiting the supplies expense by 320. Here in the second one, the amount of supplies used is 230. So the part that's used is the part that comes out of the asset and goes into the expense. So our journal entry would be to credit, debit supplies expense and credit supplies, the 230, the part that's used. And our balance would be the 435 minus the 230. That would end up being 205. Okay, here's insurance. The amount of insurance expired. Expired means used. So in this case, our credit to prepaid insurance, the asset, and our debit to insurance expense would be the 970, the part we used. Okay, and for our balance left over in the asset that we still own would be the 1450 minus the 970. That would be $480 would be the balance. In the second part of this, the amount of the unexpired, the unused insurance is 565. So that means we want the balance to be 565 of the asset because that's the unused part. So we take the 1350 minus the 565, so that would be a balance of 785. No, I'm sorry. I mean, the part that we used, I'm sorry, the part that we used is the 785. The balance is the part that's unused, which is 565. So the 785 is what comes out of prepaid insurance and goes into insurance expense, the part that we used.